Hello, everybody. We're back talking estates, gifts, and trusts. I'm Bruce Van Brady, Director of Marketing with Brady Ware, and I'm here with Mark Kassens, who leads that part of our practice. Mark, today's subject is ILITs. Let's start us off with that. Who uses an ILIT?
Hi, Bruce. So an irrevocable life insurance trust, an ILIT, is used by a settlor that is expecting to pay state taxes when they pass away. This policy is outside of their estate. It's held by an irrevocable trust, not included in their estate if it's done correctly. And the reason that these trusts are used, it provides liquidity. It can provide liquidity for the heirs of the estates, the beneficiaries. It can either make them whole for the estate taxes that the estate has paid out, or provide the liquidity to actually pay those taxes that the beneficiaries can then contribute back to the estate and kind of trade off with assets that they might not want to sell off. So basically, this is a trust that's outside of someone's a decedent's estate that wants value and also liquidity when they pass away.
Okay. How do the premiums work? Who's paying for those and where do those come out of?
Well, really, the trustee pays the premium, so the trustee is not on the hook for coming up for the money. What happens is the settlor, when they set these up, it's really funded with just the policy. So if you have a new policy, there's no value in a new policy. You have to start paying the premiums before there is value. So let's say you just start with a new policy, and you have the owner of that policy be the ILIT from the get go. Um, to fund that, the settlor would make a gift to the trustee, to the trust, and then that trustee would then pay those premiums from the trust checking account. So when they make these gifts, really, it's not a present interest gift that we talked about on one of our previous videos. So to create that present interest in that premium, and sometimes these premiums, we're not talking about a couple hundred. It's not the $15 a day type thing that you see on TV. We're talking about a substantial amount of premiums that are coming out of someone's account here. So you might have a $100,000 premium from year to year that's paying these. So you want to use that present interest amount to be able to use that annual gift exclusion. So the trustee would send out when they receive that money, they send out the crummy letters, and they have to have that money in the account too. You can't immediately get that contribution to pay the premiums and immediately pay the premiums, and then at the same time tell the beneficiaries that they have a right to withdraw that if there's nothing to withdraw because you already wrote the check to the insurance company. So the trustee has to leave that money in the account for a time, usually 30 days, sometimes 60 days or 90 days, to allow the beneficiaries to exercise that right of withdrawal if they want to. That gives it a present interest, and you can use that annual exclusion on your gift tax to minimize the effect on your lifetime exemption then. So that's kind of how it's done. I mean, it's a process. It should be done every year as the premiums are contributed. You send out your crummy letters. You acknowledge, or the beneficiaries acknowledge that they not exercising that right, or they know that they've gotten letters, and it's clear that it's actually sent out and it's done right. Uh, and then the premiums are paid. So the trustee is really responsible for paying the premiums, and he's responsible for managing the insurance policy to make sure it's enforced, to make sure everything is kind of locked in, and the trust is funded by this eventual death benefit. So that's kind of works from the get-go.
Okay. I think you just answered my next question, but who's receiving the death benefit? It sounds like the trustee.
Yeah, so yeah, when the death benefit, the beneficiary is the trust. So the trustee then is in charge of when that death benefit is paid, the trustee is in charge of going through the trust document, figuring out who the beneficiaries are of that trust, paying out the death benefit to the beneficiaries. And sometimes there's minor children involved, minor beneficiaries, grandchildren, whatever the case may be. You may have trusts set up for those individuals that are that takes care of that money until they reach the age of majority or some later
Okay.
date as
And what you mentioned, kind of comparing this against what you see on TV for the kind of that low dollar amount per day. What kind of insurance is used here?
Yeah, and those TV commercials, those are usually for term policies. And term policies are fine for an ILIT, if that suits the need of the settlor. The problem with term is it's an annual policy basically. So you're not locked into a premium, for lifetime or an escalating premium. You're basically at the mercy of the life insurance company. And that's fine if you're 40 years old, 50 years old. Once you get above that mark, though, those premiums really ramp up there because you're being insured for 1 year. And you're betting on, whether you can outlive that 1 year and beat the mortality tables. So, if you're talking about a 70, 80-year-old, those premiums can be prohibitive. So it's sometimes better to use a permanent policy, like a universal life policy. But really, that should be discussed with the insurance provider, with your insurance agent. There's a lot of different policies, new things that have come around. It's not just whole life or term. There's universal, variable life, all this kind of stuff. So it depends on the individual. It depends on the individual's assets, the individual's goals, and that can all be hashed out with good financial planning and the right insurance agent to help you along.
Okay. Well, thanks, Mark, for covering this topic. And for those who've been tuning in, and for those new on our website, on the homepage, we've got a direct, excuse me, link to all these videos. You'll see the schedule of what we've already covered and what's coming up. But you can always just subscribe and reach out to us through the contact us button on our website, or you can email Mark directly, mkassens@bradyware.com. So appreciate you guys tuning in, and we will be back with another installment next month. I'm Bruce. Once again, thank you and have a great day.